the whole system would blow up. I mean, because it would then realize that we've been lied to all along. And then has everything else been a lie too? So God help us if it's not there. Gold would go to the moon immediately. It would be a very big problem. Gold would go parabolic.
What if the Treasury's 261 million ounces of gold that they say they have isn't really there?
The idea that he could put 8,132 tons of U.S. Treasury gold into this new sovereign wealth fund for whatever purpose, I mean, I don't know where he's coming from on this, is a complete nonsense because it's not there.
Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps.
Talking about the divergence between spot, London spot, and New York delivery. And it's pretty sizable. It was bigger. It was at one point, I think it was about $80, but right now, last I looked, the London spot future in gold was about $25 lower than it is in New York futures. And I looked at it this morning, and it was like 29.27 in London and 29.51 in New York in terms of futures prices. That's almost a $25 spread. And we're seeing the same thing with silver too, interestingly. Earlier today, the London spot price was 32.74 and the New York futures price 33.38. That's a 64-cent spread. It's becoming, I think, a little bit more obvious what's going on here, and I don't know how easy we're going to see bars continue to flow this way under the guise of tariffs, but we're not seeing bars being repatriated for tariffs. These bars are being reshored. We're restocking the coffers. I don't believe that it would be, if it's coming from London, they're not doing it to preempt the audit at Fort Knox, because they would be 400-ounce bars that would be coming from London. They would have to go by way of a refining, either to the Royal Canadian Mint, but more than likely to Switzerland, and they would come in the form of 100-ounce bars. We're also repatriating them from other parts of the Orient and all around the world. We're bringing in as much as we can. In fact, we've become net importers, as we've talked about. But really what we see, in my opinion, is we will begin to see investors or big players begin to lose confidence in the paper gold markets. Maybe we're already seeing that, where there's 3 or 4 or 5 or however many contracts issued per bar. And I think what people are realizing is that physical possession is very important right now. And this could very quickly push prices considerably higher as there is a scramble for physical. And it could put some of these banks, these clearing banks or bullion banks, to the brink of collapse or default. This is an existential threat to these banks, which in my mind would trigger a cascading event. Obviously, it would jeopardize the LBMA's ability to settle contracts, but at T plus 8 weeks right now, you could argue it already is a default. And this is the largest over-the-counter market in the world for gold. Most of the transactions there are settled in paper rather than physical, but now we're beginning to see a cascade of delivery demands, which very quickly can expose the whole system.
Fascinating situation. And I've listened to all the commentary, and yesterday I listened to a conversation between various members, sort of researchers and analysts and so on, of LBMA firms, and they were saying, well, there's plenty of gold. I mean, they were just sort of glossing over the thing, really. But nobody mentioned one thing which I've been monitoring, and that is the stands to delivery. Basically, what a stand to delivery is basically where the credit market meets the road of reality, if you like. But because COMEX is run by banks, in effect, who deal in credit, not in physical, they basically, when you stand for delivery, you're not actually getting delivery. What you're getting is a commitment from the counterparty, if you like, on the transaction to deliver you gold at some stage. Now, what they do is they delay the delivery. I mean, there was a fascinating article by a guy who used to work for Sprott, and he wrote about trying to get delivery of silver out of COMEX. And basically, he said that a 5-day settlement took 9 months.
Wow.
9 months. and that was with Sprott badgering as hard as they could, trying to find out this, where is it, the whole thing. Eventually, it was delivered in 9 months. Now, the reason this is important is because stands to delivery have been increasing quite substantially. I mean, if you look at last year, just looking at gold, I took out the figures. The stands for delivery last year were 491.2 tons. Now, basically, this year, that has accelerated. So far this year, 285.3 tons have been stood for delivery.
I own an inflation hedged ETF, which has a lot of land in it that produces real assets, not real estate. So you think about gold mines and agricultural commodities, you think about energy, natural gas, oil, then that's a wonderful hedge against inflation. But I want to, if you don't mind me taking a minute talking about gold, there's a lot of reasons why gold should not be at record highs. We're keep bouncing our nose against $3,000 an ounce. And you think about it, well, we're talking about interest rates. Well, interest rates, nominally speaking, have stopped going down. They're now headed higher. The dollar has been extremely strong. Bitcoin, there's an obsessive compulsive nature in the media and even in the administration about Bitcoin. I don't understand it, but that's stealing a lot of gold's thunder. Peace is supposedly breaking out all over the world, right? Ukraine, Russia, Gaza. Well, thank God for that. I hope it's true. You have the Doge boys, or actually it's just now one, in DC supposedly cutting out waste and fraud and abuse. So that's also very positive for our fiscal agenda going forward. So that should be negative to gold. So it just bothers me a lot that gold just can't go down. Have you noticed lately that the dollar goes up, gold goes up, interest rates go up, gold goes up? No matter what happens, peace breaks out in the Middle East and in Russia and Ukraine, and gold goes up. Well, why is that? And I have a theory. I don't know if it's really. I have a theory that something's going on, and I've heard stories about a lot of gold coming into this country from overseas. Here's a theory for you, and it's not mine. I didn't come up with it myself, but I've used my 34 years of experience in this business to analyze it, and I kind of believe it might have some credence. What if, Donegan, what if the Treasury's 261 million ounces of gold that they say they have isn't really there? And you have a new sheriff in town who's prone to doing a lot of audits of things like the Fed, maybe even the audit of the Treasury. What if they're scrambling? What if they, being the United States government now, is scrambling to buy gold to replace what they've already loaned out or hypothecated or never had, those 261 million ounces of gold? That makes some sense to me. Because there's something else going on. It isn't a recession. It isn't a crashing dollar. It isn't a crashing economy. It isn't a crashing stock market. It isn't falling, plunging real interest rates. What is it? Why is gold where it is? You could explain some of it with inflation, but I think there's something else going on there, and I think what I've just mentioned could be a reason.
In today's news recap, what is the performance of gold telling us? The price of gold exceeded $2,900 an ounce last week for the first time. Since October 2023, it has risen by more than $1,000 an ounce. The price is 3 times higher than it was a decade ago. It has grown tenfold since 2000. What is going on? Where does it go from here? And how best to invest? Gold should not really be this high. Traditionally, the precious metal performs badly when interest rates rise. That is because, unlike bonds, shares, cash, or property, it does not pay investors an income. When the yields on those other assets are attractive, there is less incentive to hold the barbarous relic, as the economist John Maynard Keynes called gold. That is the case today, but still gold is hitting new records. The gold price should also prefer a weak dollar. The metal is denominated in the U.S. currency. When other currencies are strong versus the dollar, they can buy more gold. When they are weak against the greenback, they can buy less, and so the price should fall. Today's Trump-fueled strong dollar should be a headwind for the gold price. Clearly, it is not. So, the performance of gold is telling us something else. The message it sends is that all is not well with the world. It says that investors are worried, and history shows that it is unwise to ignore the signals that gold sends at times of stress. So why is gold so strong today? Several reasons. The first is gold's perceived safe haven qualities when the world looks uncertain. The election of Donald Trump has massively increased the unpredictability of U.S. policy on many fronts, but notably on trade and tariffs. At the same time, gold is a hedge against inflation. Many Trump policies, not just tariffs, are likely to be inflationary. It is a perfect storm for gold.